Okay, so I'll begin to get into the inner workings of our Canterbury portfolio thermostat, which is an adaptive portfolio strategy. So the major assumption with the portfolio thermostat is that investing in financial securities is not about risk return. It's about efficiency. And as a result, we don't assign a risk label to any asset class. So in other words, we won't say that bonds are necessarily safer than stocks. What we're saying is that every traded security will have a period of a bullish environment where it's trading very efficiently, and a bearish period where it's more erratic with higher volatility and higher drawdowns. So we have to be able to know the difference between a bullish environment and a transitional or bearish. Let's make sure that we're clear on the two kinds of risk: volatility and drawdown or declines in the portfolio. If we're going to manage volatility, we have to be able to quantify it. And at Canterbury, we developed our own Canterbury Volatility Index, which is the black line. The blue line is the Standard & Poor's 500 going back to about 2002. So the first observation I'd like for you to make is to compare the black line to the blue line. Do you see a relationship between the two? So it should be pretty obvious that the two lines are moving opposite of each other. The black line again is volatility, the blue line is S&P 500. When the volatility is low and stable like it is around 2005, 2006, you can see that that's reflective of an efficient market and one that has limited risk. We can also see as volatility begins to pick up like it is in 2007, that's acting as an early indication of some bad things to happen. So if we go back to our original question, do we need to take more risk to get a higher rate of return? The answer is no, because risk is defined as higher volatility. Higher volatility is a sign of inefficiency and is a bear market characteristic. And drawdown or decline, how is taking a larger decline in my portfolio going to actually help me make more money in the future? So we produce what are called market states. We actually have 12 different environments, but I'm going to break this down to basically just 4. The bullish environment looks like the chart that we saw earlier in 2005 or 6 when the security or the market is trading very efficiently. That's the area where we have the least amount of risk. We want a portfolio that's made up of securities that have bullish characteristics. A big part of that is evaluating the volatility. We want low and decreasing volatility. As we got into 2007, if you remember, volatility began picking up. We ended up in a transitional environment. In that case, it turned into a full-blown bear. Sometimes it'll go back to bullish. But the bottom line of this is that we want our portfolio to be efficient, and the securities within the portfolio have to be able to adapt to the environment so that our portfolio doesn't go into one of these transitional or bearish phases. So now I'll give you an example of how our market states change over a period of time. This is the Standard & Poor's 500, and as you can see, we get a new reading every day. And as we look at the red and the yellow, you can see that those are high-risk bearish environments, where on the other hand, the stock market is very safe and conservative during periods where it's green. For example, from that 2004 up through the middle of 2007 period. We actually do this for every security that's loaded in our system. We have a buy, hold, or a sell on over 1,600 exchange-traded funds. Now, as I said, every security will have a bull and a bear market state. So one of the advantages that we have today over the past is that we have over 2,000 highly diverse exchange-traded funds. Not all of these are going to be in a bullish or bearish market state at the same time. So in other words, we have different investment styles, so we can own growth or value, countries, sectors, geographic regions, industries, bonds, commodities, currencies, real estate. We also use inverse exchange traded funds for risk management purposes. As a matter of fact, during Brexit, our system had a position in inverse EFA. So instead of that international index going down 10 or 12%, the inverse went up 10 or 12%, and we were stable through that environment. So I'll cover the difference between traditional or strategic portfolio management versus adaptive portfolio management. The portfolio on the left is it's an actual real-life portfolio that was created by one of the robo-advisors with a discount firm. I answered, I think it was 7 subjective questions. It gave me a risk label saying that I was moderately conservative, and this is what they produced. I think it had 20 different ETFs. The primary difference here is, first, the maintenance of a traditional portfolio really revolves around rebalancing, as I said before. As one asset class outperforms another, you'll periodically rebalance so we can keep the asset allocation and the diversification consistent. The adaptive portfolio goes from bullish environments, watch the yellow, bearish environments, transitional, but it's going to adapt to whatever the environment is so that it can maintain consistent and stable volatility within the portfolio. Asset allocation, again, the traditional one is going to come up with an asset allocation that's in line with the risk tolerance, assuming that bonds are always riskier or safer than stocks, etc., where the adaptive portfolio is going to be variable. It's going to continually adjust its allocations, and then as we see the diversification, again, with a strategic portfolio remains basically the same. They might trade a security out if they have problems with a manager. On the other hand, the adaptive portfolio is dynamic, and the allocations and the diversification will be changing based on the environment. Manager selection. Now, if a strategic portfolio is put together by an advisor, they will typically choose active money managers, and that's where the value add is. If it's a robo-advisor, then they're traditionally going to use an index because they're all about low fees. The portfolio thermostat uses indexes. Again, we feel that the primary value add is matching up the allocation and the diversification to the existing environment, and then we'll use indexed ETFs. And there you have it. When we begin to implement something like this, typically what would happen is the adaptive portfolio goes inside the strategic portfolio. Now, if we sold half the positions and put that in the adaptive, some of the issues we begin to run into is now we have 34 funds. Our studies say that somewhere around 12 to 15 is optimal. We'll also begin to see a lot of duplication, where you can see like the dark blue ones there, which are sector ETFs. We begin to get that kind of out of balance because of the duplication. The strategic part is always stagnant, whereas the adaptive part adjusts, but if half the money is in strategic, that may not be able to manage risk quite to the degree that we would need to during difficult markets. To point out again that the adaptive portfolio strategy is not an investment strategy. It's a comprehensive portfolio management process. So as this begins to evolve with the advisor, we're going to see that the core of the portfolio should be adaptive, and then they will have certain active managers that they feel can provide value added, and that should be added on the outside as a strategic component, and then you'll have the best of all worlds. So Again, digital age is complex, but the user interface can be simple. I can, on a thermostat, set my temperature wherever I want it, and then all kinds of things happen behind the scenes to be able to maintain that. If we look at the old way of managing portfolios, it would look something like this. We have changing temperatures and seasons and no way to adapt to the environment, whereas today we now have thermostats and technology that can maintain consistency, a consistent level of temperature, regardless of what the environment is. That is the goal of the portfolio thermostat. I hope that you've enjoyed this, and we'll look forward to talking with you soon.